Good day, fellow investors. Diageo Stock, the chart doesn't look good. Similarly, Pernod Ricard also doesn't look good, but the fundamentals are there. 13 P ratio, and there was a barrage of comments, booze stocks, what's going on there, analysis. So that's something I do. I look at businesses with good fundamentals that offer good returns. With long-term P ratios of 10, you can check that exposure, what I own, on my research platform. Feel free to check it out to get also context about this YouTube channel. And the key difference between what I do and the market is that we also did 15% like the market over the last 7 years, but the P ratio of my portfolio is below 10 now, the market is above 30. Anyway, let's start by discussing Diageo, or how I pronounce it badly. I don't drink, so I don't know. But the dividend yield is, let's say, okay now. This would be the fair pricing of the company, such a company, especially because there is no real growth. If I look at here, it was flattish for the last few years. And now, given the competition, the margins, let's say, forcing growth, they have also lost net income. Long-term debt, that's something that is also weighing on these companies that are simply trying to, let's say, create some growth, something, but perhaps there is a structural issue there. And that is that perhaps the management is drinking too much of that whiskey or whatever, but brands are a little bit gone. There are all these great brands, Kraft Heinz, Nike, all struggling. So let me give you one reason why brands are gone. You're watching me, not Goldman, because if we look at Goldman's YouTube channel, 274,000, and here I must say I'm a little bit mad at you. Come on, subscribe so that we can pass Goldman Sachs on the YouTube channel. But this is one person, Sven Carlin, independent, and the brand, they have maybe more subscribers but much less views than we get here on this channel. Similarly to Diageo, Pernod Ricard, again, dividend yield 5%. Okay, good yields, but not good enough. Good for pension funds. However, organic going down, suffering across the board, and you can see brands. My friend is doing kombucha jeans, things like that, and you can see here, okay, when there was a small boom but no growth, they again do the worst thing a management can do, repurchase when things are great, then they cut the repurchases. Repurchase, when this happens, this is money thrown at the wind. Of course, everybody wants them to repurchase, but that's it. So when it comes to brand stocks, dividend is all. The rest is hope. And you don't want to invest on hope on a 4% dividend yield. High valuations without real fundamental growth, not these acquisitions, acquiring other brands, that's not real growth. It works for a while, then it doesn't. Costly buybacks, M&A that is just there to force growth, which is never good. Maybe they are cheap, maybe not. This is not a situation where I would put my hand in the fire. And there is always this questionable management. I think we can find better. So where can we find better? 4% yields would be somewhere here on our quadrant, maybe less risk, so a little bit here close to Schwab, but 4% is not going to make anything for your long-term wealth. You need 10%, perhaps even higher. You can check my research platform for that. But even if you're looking for others, check this out. Check my quadrant most recent update. I update it every month. And subscribe to see those videos in your feed so that we beat Goldman. Thanks for watching. I'll see you in the next video.